Hello friends, welcome to Learning Sessions, and today in this video we are going to discuss about the valuation of the real property. That's the last chapter from the module E of the RBWM, that is Retail Banking and Wealth Management. And if you're preparing for JAIIB 2024, you must be watching this particular video. And further, if you want to go through all the previous videos, all the previous modules of RBWM, you must be subscribing to our channel right now and press the bell notification icon so that you get updated whenever we upload the new videos. The full course videos, chapter-wise professor questions, mock test, mega mock test and PDF notes are available on our website jaib.learningsessions.in. So simply sign up over there, and also on sign up you'll be getting access to all the PDFs of all the 4 papers of JAIIB free of cost. So do sign up over there right now and start preparing for the same. You can find the link in the description box below. So let's start the session over here, and it's related to valuation of the real property. Real property means we are talking about the real estate over there. So how we are going to estimate the worth of the asset is the main challenge related to the property, and further we can be estimating the same through the future income and the advantages associated with the real property. Let's understand who does the valuation over there. So valuation actually requires the special knowledge related to the subject, related to the building cost, related to market conditions or economic trends or legal provisions, or it may be the rental income or any kind of other income, or let's say any kind of expenses that you're going to do on that particular property over there. Valuer are going to basically collect the data related to all the aspects based upon the particular building and land, and further based upon their experience and judgment and comparison among the different buildings and real estate in that particular region, they are going to estimate the value of the same. So income tax department actually grants the registration to the valuers based on their technical background. So a particular let's say particular valuer is having a technical background and whatsoever experience they are having, and the different categories based upon the different categories of the immovable property related to agricultural land or urban property or plant and machinery, jewelry, etc. The valuers are granted the registration certificate from the income tax department. So let's now understand the different types of real property. So we are having the agricultural land, we are having the urban open land, and we are having the land with building over here. So first of all, it's related to the agricultural land. Now agricultural land is actually capable of being used for the farming purposes or for raising the plants over there or the trees over there that are going to carry some value with them, right? And what are the different factors which are going to influence the agricultural land returns? That basically related to the quality of the soil. It could be related to the size of holding. Let's say case person is holding 5 acres or even holding 4 canals or something. So definitely 4 canals is of no use because it's a very small area. But if the person is holding 5 acres at a single place, definitely it will be holding a greater value than that, right? And further, how accessible it is, where are the roads situated or the link roads are situated around, or it could be related to any farmhouse which is built upon that particular area, or the fencing of the area over there, or the type of the different crops which can be grown over that particular area, right? So that are the different factors which will be influencing the agricultural land returns over there. And if we look for the method of valuation, we are having the different methods. First of all, it's related to income capitalization method. Now if I say that I can be having this future income from this particular agricultural land, now I'll be trying to calculate the present value of the same. So whatsoever the income I'm going to have in the future, I'm going to calculate the present value of the same, and that will be what? That will be the income capitalization method over there. So particularly we are going to calculate the income that will be determined based upon assuming that if the land is particularly rented or particularly crop sharing basis over there, and also we'll be looking for the expected future value and we'll be calculating the present value of the same, right? And the other one, it's related to the sales statistics method. So under the agricultural land we are having the 2 type methods. One, it's related to income capitalization method, and the other one, it's related to the sales statistics method over there. Now in this scenario we are going to estimate the agricultural land by comparing it to recently sold comparable agricultural land. Let's say case in that particular same vicinity another agricultural land was sold by person A for rupees 25 lakh rupees per acre. Now in that scenario we can be looking at the sales statistics and further can be judging that this particular piece of land will also be holding the value something comparable to the same, right? So these are 2 methods under the agriculture land. The other one, it's related to the urban land over there. Now urban open land that can be used for the residential purposes, and also that can be used for the industrial purposes. Now based upon the usage of the land and the value of the land that basically will be carrying, the land will be carrying, we will be actually be valuing that particular piece of urban land, right? And the different factors, it could be related to location of the land, that where it is located and for which purpose it is being used, or related to size of the land or shape of the land, or particularly level of the land, also related to soil quality, water availability, and also related to the width and particularly depth of the same, and further also related to restrictions on development. Let's say case if particular land is restricted that you cannot be using it for the industrial purposes, or let's say it basically confines the usage to residential purposes, which also be basically be carrying a value to it. And also if there is encumbrance, that's a charge has already been created, will also be particularly carrying the value of that particular piece of land, right? So these are the different methods. And other than that, we are having the different method of valuation for the same. We are having the different method of valuation for the same. First of all, it's related to comparative method. As we basically discussed about the sales statistic method in case of the agricultural land, the same method, it is basically related to the comparative method, that in the same vicinity is if some other piece of land is being sold, we can be looking at that particular value and further can be comparing with the same. And if it is particularly having the similar characteristics, we can be going for the similar selling value for the same, right? And the further, it's related to rent capitalization method. Let's say case the same property, building, plot has been rented out. In that scenario, we can be looking for that in a particular time period frame over there, what type of particular returns it's going to generate, and based upon that return, we can also check the particular value in today era, that in today era what will be the value of the same, right? So that's actually related to rent capitalization method, right? And further, the third one, it's related to belting method. Now belting method is actually related to what, let's say case I'm having a particular area, and I have converted this particular area into different belts, right? And for the each and every belt is particularly a set of different zones, or particularly let's say different belts, and further it will be based on the different locality, accessibility, or potential usage of the same, and based upon the same, these different belts will be valued differently. So this is actually the belting method. And further, the fourth method is related to the extraction method over there. Now extraction method is related to that when there is actually potential for development of the land over there, that we can be extracting something from the particular thing over there. So this particular method involves determining the total value of the property, then particularly subtracting the cost of development. Let's say case total value of the property related to development after development, let's say it is 10 crore rupees, and further the cost of development, let's say it was 2 crore rupees. So what will be the value of the land? Value of the land will be equal to 8 crore rupees over here, right? So whatever the amount we have spent for the improvement, development, etc., will be subtracting from the final value, and that will be the actual value of that particular piece of land over there. And further, it's related to guideline value. It's related to guideline value. Sometimes the circle rates and the government rates are being published by the government. Now these will be determining the minimum value of the land over there, right? That's the second another particular value, how we can be determining the value for the urban piece of land, right? So one, it was related to comparative method, the other one it's related to the rent capitalization method, the third one it's related to belting method, fourth one it's the extraction method, and the fifth one it's related to guideline value over there. Now the third type we are having, that's actually related to land with building. Now there is piece of land, also a building is actually built upon the same. Now we won't only be covering the particular piece of land value, but also will covering the built up cost of the land, right? So that's main funda related to what? That's the main funda related to the land with the building over there. So it is a type of real estate property that we are talking about, because it's covering both piece of land as well as the structure over there. Now what are the different methods of valuation? It's related to valuation based on profit, at what value or what profit that a particular piece of land is carrying and the particular property is carrying, and based upon that we can be calculating the value of the same, like let's say whatsoever the yearly profit we are gaining, or let's say whatsoever the tenancy profit we are gaining from the same, and we can be looking for that for what period we will be having that particular profit or the perpetuity, and based upon the present value of the same we can be calculating the value of that particular land. And the second method, it could be related to the valuation based on cost. Now whatsoever the cost or whatsoever the amount that we have spent on constructing the building, and after adjusting the depreciation, let's say the case we spent around 1 crore rupees on the particular building, and further we basically said that depreciation on the construction cost was, let's say, 20 lakh. So based upon said that, we can say the value of the land is actually equal to 80 lakh rupees over there, right? So that is actually related to valuation based on cost, and also we can be using the comparative method. So under the land with building, we are having the three methods, and also the fourth method is related to the rent capitalization method. So whatsoever the rent that you have been receiving for that particular building, we are going to calculate the present value of the same, and that by using this method we can be calculating the value of that particular building, right? So under the particular land building, we are having the four methods, and under that particular urban land, we are having the five methods, and further for the agricultural land method, we are having the two methods for calculating the valuation of the land over there, right? And further after that, it's related to the sinking fund. Now what do you mean by sinking fund? Now in the previous lecture, I have already told you related to annuities. Now annuities actually related to when you are going to deposit or you are going to pay a fixed amount at a regular interval over there, that's forming an annuity. But what if basically if I want to basically deposit the amount, fixed amount each and after each and every period, so that I'll be accumulating a fixed amount, at the end of the tenure. Let's say the case I want to buy a car 7 years from now, and for that car is valuing rupees 20 lakh, right? So what amount I should be depositing each and every month if I am able to get 8% of the interest rate, right? So what amount I would be depositing each and every year, right? So that is actually forming what? That's actually forming a sinking fund over there. Let me give you another example. Let's say the case that XYZ firm is there and that has issued the bonds. Now bonds are the debt instruments, and also the company is having the liability so as to pay the bond debt amount, that's the principal amount at the end of the tenure. That's actually the maturity value, right? So let's say case the total amount of the bond was generated to be 4 crore rupees. So the company is to pay rupees 4 crore rupees at the end of 5 years. Now in that scenario, the company is to deposit a fixed amount each and every year so that it will be accumulating the total amount of rupees 4 crore at the end of the tenure of 5 years. That is actually forming what? That is actually forming a sinking fund over there, right? So it's particularly related to a financial arrangement. What kind of financial arrangement? Which is actually used by the organizations or the individuals so as to set aside a sum of money so as to cover the future expenses over there. Further after that, it's related to depreciation. Now if you have to calculate the value of the same, now let me just take it further. So if you want to calculate the value of the sinking fund over there, how we are going to cover the same, let me just tell you. Let's just take the same example. Let you are having the total value of let's say car value is 20 lakh rupees, and further you want to basically have a sum total of rupees 20 lakh after a period of 5 years. So this is a future value that you are having right now, and the term period is given to be 5 years, and let's say 12% per annum interest that you can earn every year. So what amount you should be depositing each and every year, right? So that sum total after 5 years is 20 lakh rupees. Now just keep one thing in mind. In this particular method, are we having the present value right now or the future value? We are having the future value over there, because 20 lakh over here is representing what? It is representing the future value that we want in the future over there, right? And moreover, when the question is silent about that, when the amount is to be deposited, whether it is to be deposited in the beginning of the year or it is to be deposited in the end of the year, when the question is silent about when the amount is to be deposited, you have to consider the case of the ordinary annuity only. You have to consider the case of the ordinary annuity only and not the case of annuity due, right? So what is the formula for related to future value of ordinary annuity? The future value formula for the ordinary annuity was equal to C into 1 plus I raised to power n minus 1 divided by I. Okay, so that was the formula. Over here we are having the future value equal to 20 lakh rupees. It is 20 lakh rupees, and C amount is that we need to calculate, that what amount is to be deposited inside every year, right? And I is given to be 12%. We convert it into decimal part, so it is 1.12, and the term is given for 5 years, and for the minus 1 and divided by I, that is equal to 0.12, right? So solving this, we can easily be calculating the value of C. That is a cash flow value. We can be easily be calculating, right? So this is how you do calculate the value in the case of the sinking fund, right? And after that, it's topic related to the depreciation. Now what do you mean by depreciation? Now depreciation is basically decrease in the value of the asset over the time period. Why the value is particularly decreased? It may be due to the different factors. It may be related to the wear tear. It may be related to obsolescence of the product over there, or mere through the passage of time, right? Let's say case, did you purchase the mobile, okay, and particularly you purchase a mobile, you use the mobile for 6 months. Would it be carrying the same value with it? No, it won't be carrying the same value. Its value would be depreciated. Some of the assets are depreciated really fast, but some of the particular assets are not depreciated that much fast over there. Let's say case if we are talking about the fixture furnitures, those are not having a very high particular depreciation percentage associated with them. But if we talk about the electricals, right, or if we talk about the computers, etc., they are having a very fast percentage of the particular let's say depreciation value associated with them, right? So that's the thing that we need to consider. So that's the thing that we need to consider over there, right? So let's say case of total a new asset was particularly carrying a value of rupees 10,000. You purchased it for rupees 10,000, and let's say case the transportation cost for particularly bringing the asset to your premises was rupees 1,000 over there, and further for installation purposes you spent rupees 4,000 over there, and particularly for maintenance or something renovation purposes you spent rupees 5,000 over there. So the total cost of acquisition of that particular asset would be particularly not be booked at rupees 10,000 over there, but it will be booked at rupees 20,000. The sum total of all the expenses till you have basically made it for usage purposes over there. So it is rupees 20,000 over there, right? And let's say the case that it's having a useful life of 4 years, right? So it can be used for a period of 4 years over here, right? So it can be used for 1 year, 2 year, 3 year, 4 year, and you are to use the SLM method of depreciation. Let's say case that you are to use the SLM method of depreciation, that is straight line method of depreciation. Under the straight line method of depreciation, the fixed amount of depreciation would be charged throughout the life of the particular asset over there, right? Now in that scenario, 20,000 is actually divided into 4 years. Why? Because the particular asset is having a useful life of 4 years. So particular, as I told you, equal amount of depreciation is to be charged. So each year the depreciation would be charged at 20,000 divided by 4, that is 5,000 rupees of depreciation will be charged for each and every year, right? So this is clear, right? Or other way we can be calculating like that what amount of what percentage of depreciation will be charged. So 100% is the total, and further the total useful life is 4 years. So 25% of the depreciation will be charged each and every year. Now 25% of 20,000, that will be amounting to again 5,000 rupees over there. So 5,000 rupees of depreciation will be charged for each and every year. Now when the first year of depreciation will be charged, what will be the net book value? What will be the net book value? The net book value would be equal to, for the first year, net book value for the first year, it will be equal to 20,000, that was a book value, okay, and for the minus the depreciation amount, that is 5,000, that will be equal to 15,000, right? And the next year the net book value would be equal to 15,000 minus the 5,000, that will be equal to 10,000, and at the end of the tenure the asset will be having the zero value. It will be having the zero book value over there, right? And also there is one other concept associated with it, that is actually related to the salvage value. That is actually equal to the salvage value, or we also say it to be the residual value, or we also say it to be the scrap value. Whatsoever the name it is, it means all the same. That what is the value that it will be having in the very end when it will be it can be sold as a scrap over there, right? Let's take the case that it is having a, let's take the case it is having particularly the salvage value of 4,000. It is having a salvage value of 4,000. Same case, it's having a salvage value of 4,000. In that particular scenario, what will be the, how we will be calculating the depreciation? Because the total cost of acquiring the particular asset was 20,000 minus the salvage value, that is equal to 4,000. That is equal to 4,000. Now the value over which the depreciation is to be calculated is 16,000 rupees. Kindly please take a note that you are to subtract the residual cost front end. Residual cost first front end over the amount for which you need to calculate the depreciation for, right? So for the first year, after the first year, the depreciation would be, after the depreciation, the amount would be equal to, net book value would be equal to 16,000, and for the depreciation would be charged at, because it's having a useful life of 4 years. So what will be the depreciation? It is 100 divided by 4, it is equal to 25% of depreciation is to be charged each and every year. So 25% of 16,000 is equal to 4,000. So net book value after 1 year, it will be equal to 12k. After second year, it will be equal to 12k minus 4k, that is equal to 8k, and as on, right? So when the 4 years would be elapsed, the book will be indicating you scrap value only, that is of rupees 4,000 over here, right? Is that clear? So that's about the straight line method of depreciation. So straight line method of depreciation will be assuming what? That the asset will lose an equal amount of value for each and every year, and depreciation would be calculated every year on the depreciable value of the asset, not on the book value of the asset, but on the particular depreciated value of the asset over there, right? And further amount of depreciation is constant for each and every year that we have learned so far, right? And what is the formula? Formula is given to be depreciation per year. Formula is actually cost of asset. Like we basically considered the cost of asset is 20,000 rupees over there, and particularly the salvage value was 4,000 rupees over there, and particularly useful life of asset was 4 years, right? So depreciation per year would be equal to 16,000 divided by 4, that is equal to 4,000 rupees over here, right? So this way we can easily be calculating the depreciation value per year, right? And after that it is equal to WDV method, that is a written down value method, or we also say it to be the diminishing value method. In case of diminishing value method, a fixed percentage of the amount is actually debited as a depreciation expense, right? And depreciation is what? Depreciation is a non-cash expense. Depreciation is non-cash expense, because when we are going to actually deduct the depreciation, the amount is not going anywhere. It is still with the company. Right? So that's why it is said to be the non-cash expense. Let's say case that you purchase an asset for rupees 1 lakh. You purchased an asset for rupees 1 lakh. So it's having a book value of 1 lakh over here. And let's say case the written down value depreciation is given to be 20% over there. The depreciation percentage is given to be 20% over there. In that scenario, the net book value after first year would be equal to 1 lakh minus 20%. 1 lakh minus 20%, that would be equal to amount of depreciation is equal to 20,000, and 1 lakh minus 20,000 is equal to 80,000 over there. And the next year, that is net book value after second year, it will be equal to 80,000 minus 20%. It will be 80,000 minus 20%, that is equal to 80,000 minus 16,000, that is equal to 64,000 over there, right? And so on. So for the third year, it would be equal to 64,000 minus 20% again. It will be equal to 12,800 we have to subtract from the same, and it will be equal to let's say 53,200, or sorry, it will be equal to 51,200 over there, right? Okay. And what are the different features related to it? Let's understand what are the different features, because in this scenario, in the case of written down value or diminishing value method over there, depreciation is calculated every year on written down value. So we basically use the previous value, that is for the first year, whatsoever the last value, we use that particular value so as to calculate the depreciation amount for the next year. In the case of SLM method of depreciation, we actually use a percentage, like as I told you that 25% depreciation is particularly charged in the particular example above. In that scenario, we charge that particular depreciation on the value of acquiring that particular asset. That is, we calculate it on 20,000 or 16,000 over there, okay, and not on the diminishing value over there. But in case of WDV method, we are going to calculate the amount of depreciation on the diminishing value over there, right? So that's the difference between the same. After that, it's related to the reverse mortgage. Now, what is reverse mortgage? Reverse mortgage is actually a financial arrangement. It's a financial arrangement where the financial institutions are enabling the old homeowners, that they can be converting a portion of their home equity into cash. Let's say case that you are having a home with you, but you are particularly, let's say you are old enough and you are not having any kind of other income sources with you. So you can actually be doing what? You can be coming under the concept of a reverse mortgage, where you'll be mortgaging your property with the bank. Bank will be paying you either a lump sum amount. And also a fixed annuity amount. That is a fixed particular cash flow amount will be paid to you for a fixed period, let's say for 20 years or for 10 years, right? That will be paid by the bank to the borrower, and the borrower needs not to repay that particular amount. So from where the amount will be repaid? When the borrower will be deceased, when the borrower will die, then this particular house will be sold off, and whatsoever the cash flow would be there, that will be used so as to repay the whole amount. Principal plus interest amount will be paid upon it, and whatsoever the fee charges was there, that will be used so as to pay for it, right? And further, if there is any surplus money, that will be returned to the legal heirs of the borrower. Okay, so that's a concept related to it. So what is the main benefit? First of all, home equity conversion, that you can be converting your home into a particular equity. You can be getting some value for it, and you need not to pay any kind of monthly payment for the same. And loan repayment is not required to be done, and that will be repaid through the amount of the home that you have sold off, and that will be used, right? And for the ownership will be remaining with you. Like person A has actually created a charge with the bank over there, and person A will still be having the ownership. Person A will still be having the possession of the same, right? And further, it's non-recourse loan. Non-recourse loans means what? Let's say case that person A took a total loan of rupees 20 lakh from the bank, right? And further, along with the interest, the total amount grew up to rupees 35 lakh. The total amount grew up to rupees 35 lakh. But when the property was sold by the bank, after the death of person A and the spouse of person A, when the bank sold the property, it was sold for rupees 32 lakh. It was sold for rupees 32 lakh. So it's not the case that the bank will be asking the legal heirs of person A so as to repay the loan amount. That is what we meant to say, that it is non-recourse loan, right? So what is actually difference between the traditional mortgage and the reverse mortgage? For what purpose it is used? The traditional mortgage is actually used if you want to basically purchase a loan, or if you want to basically take a loan for the home construction, etc. That was a traditional mortgage. And what is a reverse mortgage? That we are already having a home and we want to get the money for the same particular home. That's actually the reverse mortgage, right? And is monthly payment required in case of traditional mortgage? Yes, it is required. But in case of reverse mortgage, it is not required. It is quite optional in that scenario. It is quite optional in that scenario. And for the loan repayment, it is to be repaid. In case of traditional mortgage, it is to be repaid in monthly installments, whereas the loan repayment will be done by selling the home when the borrower passes away or the person has moved from the home over there. In that scenario, the loan will be sold and the loan amount will be repaid, and home ownership in both the scenario will be remaining with the borrower over there. And if we talk about the loan amount, it will be based upon the income of the borrower, it will be based upon the take home salary, or it will be based upon the credit and for the home value over there. Whereas in the case of the reverse mortgage loan, RML, it will be based upon the age of the borrower, it will be based upon the home value of the borrower and the interest rate over there, right? Based upon that particular loan amount will be set, right? So what is RML? The RML scheme was actually introduced in India by NHB in 2007, and further it was applicable in India from the 1st April 2008 over there. Now this scheme is actually there so as to help out the senior citizens who are not having any kind of particular periodic let's say revenues with them. Now they can be actually be placing their property with the bank, and further can be taking the annuity from the bank over there, lump sum amount from the bank over there, right? And at the still time they can be residing inside the home, they can be having the possession, and further they can be having the possession of the home till they are alive, and further their spouse is alive. And what is the eligibility criteria? The eligibility criteria says that the Indian citizen above 60 years of the age are eligible. Above 60 years of the age are eligible, and married couple will be eligible as joint borrowers. Okay, they will be eligible as joint borrowers. So if A and B are spouse and particular husband wife, in that scenario both to be co-borrowers, right? And for the at least one of them, if the person A and B are taking a joint loan, RML, in that scenario at least one of them must be aged 60 or above. At least one of them must be 60 or above, and the other one should not be younger than 55. Other one should not be younger than 55. And further they must be owner of a residential property that is located in India with a clear title, and for the residential property must be free from any kind of encumbrances, that it should not be having any kind of charge upon it. And further the residual life of the property should be at least 20 years. And prospective borrower should be used at residential property for permanent residence, primary residence. So it must be permanent primary residence where they have been residing. Okay, and for the commercial property is not eligible for the RML loans over there, right? Now, what are the salient features? The senior citizen borrower is not required to service the loan. That's the first thing. You just take a loan, you just took an amount. Either you basically take a lump sum amount from the bank, or bank is actually paying you annuity over there, but you need not to repay the amount. The bank will be recovering the loan from selling the house. When the borrower passes away, the bank will be selling the home, and for the what's the amount that will be adjusted, right? And RMLs are extended by primary lending institutions, scheduled commercial banks, or particular housing finance companies, right, which are actually registered with NHB. So whatsoever the particular things are, financial institutions are registered with NHB, they can be doing what? They can be actually be extending the RML over there, and monthly maximum payment is actually capped at rupees 50,000. So maximum annuity amount which can be paid by the bank to the borrower is capped at 50,000 rupees over there. That's the first case related. And for the maximum lump sum amount that can be paid to the borrower at once, that can be maximum up to 50%. That can be maximum of 50% of the total loan eligible under the RML scheme over there. So if the borrower was actually eligible for 10 lakh rupees, in that scenario, the borrower cannot be paid a lump sum amount of more than 5 lakh rupees over there, right? And further, that is also capped at what? the total eligible amount of the loan is capped to a maximum of 15 lakh purposes. It is capped to a maximum of 15 lakh purposes over there, and this particular lump sum amount can be taken for the medical treatment for the self, spouse or dependent over there, and the balance amount would be eligible for the periodic repayments, and the disbursement of the periodic repayments can be quarterly, it can be half yearly, it can be yearly, it can be monthly over there, right? And the maximum period of the loan is actually restricted to 20 years. The maximum period of the loan is restricted to 20 years over there, and all the payments under RML are exempted from the income tax over there. It's not the case that whatsoever the amount you are receiving, you have to pay the income tax over the same. No taxes to be paid on that particular amount over there, and RML will be settled through the proceeds which will be obtained from the selling of the house over there. And as I told you, if there is any amount surplus left, let's say case you took a total loan of rupees 15 lakh. You took a total loan of rupees 15 lakh, and for the amount after interest, the principal amount and plus total interest amount, basically that was amounting to rupees 22 lakh, and your property was sold for 32 lakh. So there is extra additional 10 lakh rupees. Now that amount will be paid to the legal heirs. It will be paid to the legal heirs of the borrower or to the beneficiary, or particularly let's say to the spouse, or it may also be the case if the borrower has actually moved to some new house, then if the house is sold, and that's why it may also be paid to the beneficiary, right? Now what are the limitations? As I told you, the particular amount tenure is actually to be fixed to be 15 to 20 years. That's the first limitation. The loan amount as compared to the value of the home, it's quite low because it's totally capped at 15 lakh rupees over there, and actual monthly payments one will receive in reverse mortgage loan is quite low. If we basically do consider with the market interest, let's say case if a home is having a total value of 70 lakh rupees, whatsoever the fixed amount of particular annuity that you will be receiving per month, that is actually quite low. Right? And that these are the main particular limitations. And the other one, it's related to property will be assessed periodically. Right? Let's say case that you took a loan in 2016, and further property will be assessed in 2019 also, 2020 also. Now if there is actually reduction in the market value, let's say previously the market value of the loan was 35 lakh rupees, but now the property value is, let's say, 20 lakh rupees. There is a recession, let's say, and the property value basically now reduced to 20 lakh rupees. In that scenario, the owner will be bear the burden. The owner has to bear the burden over there, that your annuity amount will be decreased, right? So that's the case related, and those are the limitations associated with the same. I hope that you must have liked the video and further the content of this particular video, and that will be related to it. So that will be all. So kindly please do rate the session out over here, that out of 10 over here, and further you can get the full course videos, chapter wise previous questions, mock test, visiting our website JAIIB.learning/session. So simply do sign up over there, and further on sign up you'll be getting PDFs for all the 4 papers of JAIIB. So do sign up right now and start preparing for the same. Thank you so much, and see you again in the next video.